Hey traders, this is Danielle, and today I'm going to be talking about GameStop earnings. Now, GameStop gets a lot of hype because of Wall Street Bets, Reddit, all that kind of stuff, and because it's a potential short squeeze. But I'm looking at this as an overnight earnings trade. So I don't own shares of GameStop. I haven't really been trading it. I did make a video 3 weeks ago when I, said that it was entering the hot zone and it was probably going to rally into earnings, which that was a pretty nice move. But now we're at the point where we actually have the earnings report at our fingertips. Now, when I'm looking at trading earnings in the options market, it just provides a unique opportunity because of the way that options are priced. Options get really expensive going into earnings, but then what happens is the value of those options goes down immensely overnight on the earnings report, okay? So when you are versed at buying and selling options, it provides you some opportunity. So what's really interesting looking at GameStop here in the hot zone is that the market maker expected move is $47. Now, when you look back at how much this thing actually moves on earnings, even when the price point was pretty similar to where it is right now, well, I guess not too similar. Let's see. Where was it trading? I was trading at $186 a share, let's call it. And we're trading at $280. So, still. We only moved 23 bucks, which was a 13% move, all right? And what was really interesting about that move is you see how it basically had earnings, gapped down, and 3 days later it was trading at the exact same spot. Okay, well, if you look back at the quarter before that, similar situation. You had a rally into earnings, gap down, and then a week later it's trading almost in the same spot. Well, in the options market, what I like to do with stuff like this that has really high implied volatility and it has a huge market maker move priced in is just come in and sell some premium because the value of those options is going to go down overnight due to the earnings event and the IV crush. So the main thing is you just have to determine a direction. So do you want to, A, if you think it's going to go higher, you can sell just the put side premium. B, if you think it's going to go lower, you can sell just the call side premium. Or C, you say, hey, I don't really care which direction it goes. Let's just sell the at the money premium on both sides, and maybe it'll go like this, and then it'll end up right around the same spot, and then I can, buy back the credit that I sold. First of all, if I look at it, it seems pretty obvious to me that the earnings have not been doing really well, and it makes more sense to just straight up sell a call credit spread. The only reason that gives me a little bit of hesitancy is just because it is a short squeeze possibility. So you got to watch out for that. But again, just, risk what you're willing to risk. I would definitely not sell the put credit spread just because I'm not bullish GameStop on earnings. But I do think that traders could come in here and look at this 267% implied volatility and just straight up sell the at the money premium. Now, I'm going to give you an example with a 300 strike just because you see a lot of high open interest there. And I don't really think that the 280 is going to be the best spot, but it's all going to depend on where it's actually trading going into the report. So keep in mind, I'm only choosing this strike right now for example purposes, but the way that I would actually do it is whatever this thing is trading at going into earnings. For example, if it was at 300, that's when I would select the 300 strikes on both sides, okay? So for simplicity's sake, we're going to pick 300 just for the even numbers. But for example, you have a market maker expected move of $47. So you need to come in here and do 300, 350, 300, 250. It gives you a credit of $39. So let's just price it out for one contract. Basically what that would look like is, you're risking 1 to make 4 on earnings. Basically, you're risking $1,000 to if this thing, popped up, pulled back, and then it stayed around that same price, the max would be $4K per contract. Now, on these types of trades, this is going to be a Wednesday going into Thursday. Generally, I would target anywhere between 30 to 40% of the credit. So if the credit is, let's say, $40, you just have to figure out, okay, what is 30% of that? And then that would be my price target, okay? So the goal with this type of trade, basically, you just sell the premium because it's super expensive and outrageous, and you look for the fact that this thing is probably not going to, have some type of amazing move either which direction. It's probably just going to crush a lot of the people who are buying long calls on earnings. So that is how I would trade that in the options market. Again, this is not something that I would do until the day of earnings. Just do it. Let's see, let me get my calendar up here actually. It's on the 9th, it looks like, and I think that it is, let's see, it was after market close, I think it was. Yeah, it's after market close, so I would do it like the last hour. But I'm going to be placing these orders in my mastery program, so I have an options picking mastery service. You can go to simplertrading.com/profits, check it out. I'm going to be having a 2-3 hour long live trading session tomorrow at starting at 1 o'clock Central Time. So if you want to check it out, I'll be there going through more of these trades. And if not, no worries. I'll see you in the next one.
Without Simpler Trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency.
It's one of the things that won me